before I became successful, or terminologies that I learned along the way on my crypto journey that kind of helped me understand what a lot of these people are talking about in the crypto space. And so I've kind of condensed these for you guys. At first, my list was really long in different terms that I could give you guys, but a lot of the terms that I realized that were on that list aren't frequently used or aren't even used as often. So basically what I did was, like I said, condensed it down, maybe took off like one or two things that weren't really that necessary, that can kind of help you guys when it comes to these terminologies. So there's no specific order for these, whether it's going to be if they're novice right off the bat or expert later. There's no specific order. They're just kind of thrown in there so you guys can kind of get the gist of what a lot of these words mean. So starting off the list, first of all, we have DYOR. So a lot of us already know this, and it's super self-explanatory. And I believe I don't really need to explain too much on it, but it basically means do your own research. So whatever you guys do or whatever assets you guys get into, make sure you guys do your own research on that asset. See if it's something that you guys like, or see if it fits within your guys' investment portfolios, and you guys can continue and go on from there. On top of that, the next one we have is a trading term that a lot of you guys will probably understand, but for those new people who aren't even in the crypto space or aren't even in the Forex side, we've got a bear market. So whenever you hear that crypto's in a bear market or Bitcoin's going to go bearish soon or anything like that, what you guys want to understand is that basically just means that sellers are in control. We're in a market where there are more sellers than there are buyers. So when you hear the word bear market, that just generally means that the markets are going to be red for a few days. The assets are going to start dropping and sellers are in control. A lot of people are either taking profits or moving profits. Next thing we have is going to be a block. So you guys might have heard the word blockchain, which is going to be another terminology that I go over later on in this in these slides here for you. But basically, a block is a file that stores transaction data. So a block on the blockchain just contains all the data of your transaction. Next up, we've got FOMO. So again, FOMO is a word that you're going to hear lots of. Basically, it just means fear of missing out. So when you see an asset that you were planning to get into, but you didn't get into that asset, what happens is we tend to develop what is called FOMO, or the fear of missing out on the potential gains that that asset could give us. Now, for those assets there's good FOMO and there's bad FOMO. It all depends on what your fear of missing out or what your expectations on an asset is, and that's where you guys get the term FOMO. So don't worry about that too much. Next up we have is FUD, and FUD gets spread like COVID on a outdoors party. I have no idea. But basically FUD just means fear, uncertainty, and doubt. So whenever there's fear in the markets, whenever there's news coming out of a potential asset, whenever there's news coming out about a big exchange, or there's a lot of that uncertainty in what that exchange, or a lot of fear in the markets coming out, that's basically FUD. It's fear, uncertainty, doubt. Now, you want to try to minimize your exposure to FUD. Now, FUD can be everywhere, and especially in bear markets, but you just kind of want to minimize your exposure to FUD, and at the same time as well to make sure that you're in the right headspace to handle all of that stuff. Now, on top of that as well too, next up what we have is fiat. Now, fiat is basically to keep it super simple, it's the native currency of a country. Now, my fiat currency, because I live in Canada, is Canadian dollars. Now, for some of you guys out there in the States, now your fiat currency is going to be the US dollar. In Germany or anywhere else, whatever your fiat currency is, Europe, I meant to say, it's going to be the euro. So that's basically fiat, is the native currency of a country. Next up, you guys have been hearing this word a lot lately, and it's been all over the news in crypto, and that's NFTs, which are non-fungible tokens. Basically, they're just digital works of art that are being made on top of the blockchain. Now, fun fact actually about NFTs, Gary Vee is actually releasing another NFT coming out here, and that NFT is going to be giving you an access to his restaurant that he's opening in New York City. So if you guys have that Gary V NFT, you guys are able to enter into his restaurant, and depending on the NFT you guys purchase, at the same time as well too, he has different packages and different treatments that you're going to get at his restaurant. So that's NFTs, non-fungible tokens, basically digital works of art. Next up we have is ATH, and a lot of these assets are doing this right now. They're breaking their all-time highs. They're coming up to an all-time high. We just had Cardano just last week hit $2.90 or close to $3 to break its all-time high. We've had a bunch of assets this past week break their current all-time highs. So that basically just means that the price of a token has reached an all-time high, an all-time new value, an all-time high new value. Next up, we have DCA. Now you're going to hear this a lot as well too, especially if you're going to be investing or if you're a new investor and you don't want to toss in a lot of capital into these assets. Now this one here, DCA, is dollar cost average. Now what dollar cost average means is basically, let's say you have $100 to spend and you want to buy an asset, but you don't want to put in that full $100 right off the bat. So what you're going to do is you're going to dollar cost average that asset. You're going to put in $25 at the beginning, $25 to buy the next dip, $25 to buy the next dip, $25 to buy the next dip. So you're dollar costing your average on your price point of the asset that you're getting, but at the same time you're capitalizing on a lot of these moves. So dollar cost average is great for to keep in mind. Next up is we have altcoin. Now altcoin, you're going to hear a lot of. Basically altcoin just means anything other than Bitcoin. It's an alternative to Bitcoin. So Bitcoin's its own little thing. All these other cryptocurrencies or tokens, Ethereum, ADA, XRP, all of that there are going to be altcoins. Next up, what we have is, like earlier when I was speaking about a bear market, now we have a bull market. And a bull market is generally the opposite of what a bear market is. It's where buyers are in full control. Now, because a lot of you got, depending on if you guys are in either crypto, forex, or if you guys are just new to these spaces completely, the reason why they're kind of called bull and bear markets, bears, they generally attack down, and bulls with their horns, they attack up. So that's why when you hear the terminology bull market, just remember that buyers are in control, and you're going to see a lot of green days on those in the markets. Next up, what we have is a blockchain. Now basically a blockchain, to sum it down, I'll do a full course on blockchain at another date, but on blockchain, to sum it up, it's basically a digitalized ledger that records transactions. So any transactions that happen, let's say with Bitcoin, are recorded on the Bitcoin ledger or the Bitcoin blockchain. So any transactions that happen with Ethereum are recorded on the Ethereum blockchain. Now, at the same time as well too, you're going to hear this a lot too. So there's going to be crypto coins and there's going to be crypto tokens. So I'll go over the two differences. But a crypto coin is basically a cryptocurrency that runs off of its own blockchain. Bitcoin has its own blockchain. Ethereum has its own blockchain. Cardano has its own blockchain. Dogecoin has its own blockchain. So all of those are considered coins. Now, if it's an asset, and I'll go over tokens later when the definition comes up, but basically the differences between a coin and a token is that a coin operates off of its own blockchain. Now, this one I love. So this one I love because this one's a little meme joke that you're gonna hear a lot of. So it's basically haha money printer go brrr, or basically what it's saying is that whenever the government prints more money, aka stimmy checks, or whenever the government in the past 2020 were printing out a lot of dollars, the money printer, the money machine was going brrr all year long. So with that being, I'm glad. That's awesome. But yeah, money printer go brrr is when the government basically prints more money, aka stimmy checks or anything like that. Now hard cap. Now, hard cap is basically the max amount of funds a project intends to raise during an ICO. Now, I'll go over the definitions of ICO, IEO, and IPO and everything like that. But just keep in mind when you hear the definition of a hard cap, that's basically the max amount of funds a project intends to raise during an ICO. Now, we all hear the term HODL. Now, HODL basically just means hold on for dear life. It just means when somebody says HODL this asset, it just means hold this asset and don't worry about selling it. HODL was just a typo mistake when somebody was writing something, and if it's turned into this word that means so much in the crypto industry, which is basically hold on for dear life. No matter what, just hold on for dear life. Now, honeypot. Now, the official definition for a honeypot is basically a mechanism used in computer security to detect or counteract unauthorized access of information. Now, at the same time as well, too, there are honeypot schemes that are out there in the DeFi space, but that's not generally what a honeypot is. A honeypot is basically a mechanism used in computer security to detect or counteract unauthorized access of information. Now, at the same time as well, speaking of DeFi space, we have the term DApp. Now, I know we use this a lot, or it's going to be tossed around a lot, where it's DApp this, DApp that, DApp this. Basically, a DApp is a decentralized application that runs on a peer-to-peer network rather than one central computer. So basically, it runs off of multiple networks rather than one computer having this application. So that's what you hear when you hear the term DApp. It's basically a decentralized application. Now, on top of DApp, you also have DEXs, which is basically an exchange that does not require users to deposit funds to start trading. Users can trade directly from their wallets with a DEX, or also known as a decentralized exchange. So with this, you can set up your wallet, like if you guys have already been purchasing through MetaMask or Trust Wallet, you guys are accessing things like PancakeSwap, Uniswap, what else? What other swaps are out there? But you guys are accessing those, and those are decentralized exchanges that does not require users to deposit any funds to start trading, where you can, again, users can trade directly from their wallets and have access to those right there. Now, speaking of DeFi, I've used that term quite a bit here. Now, basically, DeFi just means decentralized finance. It's basically an ecosystem made up of decentralized finance applications that are built on top of the blockchain. So that's everything that's related to DeFi. Anything that's made on top of the blockchain that has to deal with decentralized finance falls under the DeFi category. Now, the opposite of DeFi is where you're going to get the centralized. So anything that's centralized just means, very simple, just one governing body controls all the decision makings of that. So when you have DeFi, it's basically, again, decentralized finance applications. When you have something that's centralized, it's one governing body controlling all decisions. And something that I wanted to toss in there, which is important to learn as well too. Now, some of you guys may have heard of it, some of you guys may have not heard of it, but it is known as the 10,000 Bitcoin pizza. So basically, what this was the first real transaction made with Bitcoin way back in the day when a gentleman bought 2 large pizzas for 10,000 Bitcoins. And if we're looking at the price of Bitcoin right now, Canadian dollars, the price of Bitcoin, I believe, is at 60,000. So back then, that gentleman, he would have had $600 million if he would have just kept that. But what this really means for the crypto community is that this is the first real use case to prove that Bitcoin is more than this internet fad. It can be used for real life use case, real life transactions. And that's why this is so important in crypto, because even though this gentleman gave up 10,000 Bitcoins for 2 large Papa John pizzas, and I'm serious, they're Papa John's pizzas, 2 large Papa John pizzas, he was basically set the setting ground for what Bitcoin is today, which was awesome. And then next up, what we have is a block explorer. So basically, a block explorer is a website that allows users to check on all transactions on a certain blockchain. So you have things like BSC scan or Ether scan or Bitcoin block explorer. So you have those sites that are out there that allow you to check on assets, any transactions, or anything that's happening on that certain blockchain. So that's basically what a block explorer is. Now, you guys may not have, whether you guys are new in this space or if you guys have been in the space for a while, you may have seen or heard the word DAO being thrown around, depending on where it was. Now, basically a DAO or a DAO is a system of hard-coded rules that define which actions a decentralized organizations will take. So think of it as kind of like a system, again, a system of hard-coded rules that define which actions a decentralized organization will take. So it's just like a guideline. Now, what we have here is we have BEP2 or BEP20. Now, this is mainly just for the Binance. You guys will see that if you're interacting with things like PancakeSwap or PancakeSwap or 1inch Exchange or anything like that when you guys are using your MetaMask or Trust wallets or buying these smart contracts or these assets that we're purchasing. Now, basically, BEP2 is just the standard of all BNB transactions. It's if you were to buy BNB, it would be BEP2. Now, if you were to go into your Trust wallet or your MetaMask, and from there you guys wanted to go out and use PancakeSwap, but you guys know you have to switch it over to Binance Smart Chain, that's BEP20, which also known as Binance Smart Chain, which offers lower costs and allows users to use them for the decentralized applications. So that's basically just the gist of what you guys need to know in the difference of that. Now, at the same time as well, you guys will have things such as KYC when you guys are opening up different exchanges or you guys are going on to different sites and trying to open up an account. Now, basically what KYC is just to know your customer verification. It's just basically saying that it's just a way to confirm that you are who you say you are. They'll ask for things like an ID, and then I bet you guys all had to do that jailhouse picture where you have your driver's license, you guys have your driver's license, you guys have the date written, and you have to hold it in front of a camera and take a selfie. And yeah, so that's basically what a KYC is. It's just to know it's just to know who the customer is, and it just basically exactly the mugshots. Just give me 1 second there. Yeah, the mugshot photos, they're great. And it's always they catch you at the wrong time too. Like you've just waken up in the morning, you're just trying to make an account for an exchange, and next thing you know, they're asking for a mugshot. It's great, I love it. But yeah, I broke my glasses there. But yeah, so it's just to know your customer that way. Now on top of that as well is the RSI. Now if you guys are in trading, you guys have probably heard this term. Now this, if you guys are not in trading or if you guys don't know anything about an RSI, basically it's just a relative strength index or indicator used to identify overbought and oversold conditions. Now a lot of crypto traders will use this as a way to confirm if an asset is overbought or if it's oversold, but that's if you were to trade cryptos. Now this is just another thing to look at as well too. Now something else you guys are gonna come across is gonna be the ROI. So this is just a general term that not even a lot of people know, and I know this from personal experience because I just learned this term the last 2 years, which is absolutely crazy. But ROI basically just means return on investment. It's the ratio between your net profit and your net cost. If you were to buy something for a price that's down here and you were to get a price that's up here, that's your ROI, your return of investment. Now, other than that, what we have as well too is going to be a layer 2. Now, when you hear the word layer 2 being thrown around, like Cardano doesn't have a layer 2 or this is a layer 2 protocol, basically what a layer 2 means is it's a secondary framework or protocol that's built on top of an existing blockchain to help with scalability. Now, basically some blockchains are built the way it's built, but later down the road they're trying to get bigger and they're trying to scale. Now layer 2 protocols help with building on top of that blockchain and helping it with that scalability issue. Now, another thing, like I was talking earlier, were the ICOs, IEOs, and IPOs. Basically, when you hear the word ICO being thrown around, ICO is basically just an initial coin offering where new projects will sell their cryptos to investors. That's really all an ICO is. When a new coin or a new project's being made, they'll sell their crypto to investors to help with that project. Now there's IEOs, which is an initial exchange offering where a fundraising method is designed to reduce the risk for token purchasers by introducing a trusted intermediary between the project team and the users. So that's basically an initial exchange offering. Now, when you hear IPO, an IPO is an initial public offering, and it refers to the moment a private company starts offering its shares to the public. Now, on top of that as well too, you have the term Monet. So when you hear things like way back in March, Crypto.com released their Monet, or this project is having a Monet feature being released. It's basically a blockchain protocol which is fully developed and deployed where transactions are already being broadcasted on that network. So that's basically what the Monet is. Now, we've all heard this in the news, and it's been a struggling battle between XRP and the SEC. Now, it's something that we need to understand is who the SEC is. And basically, the SEC is just the Securities and Exchange Commission. They're the government agency responsible for regulating the securities market. Now, when it comes to securities and cryptocurrencies, there's a really tight fine line between what is a security and what is a crypto, and that's why they're struggling that battle between the XRP and the SEC, as you guys will hear in the news a lot, especially coming into the crypto space. Now, on top of that as well too, you guys might hear the word SEFU being thrown around. Now, basically what SEFU is, it's a secure asset fund for users. SEFU is a secure asset fund for users and an emergency insurance fund for users as well too. So that's basically what SEFU means. Now as well too, you guys have P2P or peer-to-peer. It's basically where two or more computers are connected to share a workload or a resource. So you're going to see a lot of these cryptocurrencies that say peer-to-peer network. And that's exactly what it is. It's where two or more computers are combined using their computing powers to share a workload or a resource. Now, at the same time as well too, you guys are going to see POS. Now, this is going to become very popular going down the road, especially for Ethereum, because they just released their Ethereum 2.0, which is their proof of stake. And proof of stake is a form of consensus where users are rewarded based on the amount of coins they have staked. So with Ethereum, you need about 32 ETH to participate in their proof of stake system, where you can now, instead of buying all these fancy mining machines, you can now instead take 32 Ethereum, stake it online, and then you're rewarded the exact same amount of rewards. Instead of having all hundreds of $1,000s worth of machines, you're just staking your dollar figure or your coins. Now, next up, we have a word that is a really big word. So this word is interoperability, which basically just means the ability for multiple blockchains to interact with one another. So this is going to become huge later down the road, is having coins or tokens or projects that are out there that are able to allow different blockchains to connect and interact with each other. It's basically like how a cell phone works, where I can call somebody on the other side of the world and I'm exactly where I'm at right here in Canada. It's just allowing that different blockchains to interact and connect with each other. Now, you guys are also going to hear things like Hardfork or yeah, basically you guys are going to hear things like a hard fork is coming. So basically what a hard fork is, it's when it's what happens when a blockchain goes into two different paths. So let's say a blockchain decides to go in one direction and it's trying to keep continuing going further, but there's a lot of issues with it. So what happens is a group of people or a group of nodes that are on that blockchain will decide to go in another direction and create a different a fork of that exact same coin or token. So think of it like a fork on the road. You're driving down the road, you want to exit off this lane, but it forks off into two different lanes that can take you two different paths. So that's basically what a hard fork is. Now at the same time as well too, you're going to hear the word Satoshi. Now there's Satoshis and there's Satoshi Nakamoto, which I'll go over real quick. But basically a Satoshi is the smallest unit of a Bitcoin. I believe it's like 0.000001 of a Bitcoin. And that's basically what a Satoshi is. Now, when you hear the name Satoshi Nakamoto was basically the creator of Bitcoin, as well to the creator of the Bitcoin white papers way back in 2009. Yes, for sure, I can definitely do that here. Now, Satoshi Nakamoto is basically the creator of Bitcoin. We have no idea who he is. It's just a pseudonym that was left online, and that's basically Satoshi Nakamoto. There's a lot of people out there that are claiming to be Satoshi Nakamoto, but there's no proof that they are Satoshi Nakamoto. So that's where we're at. Now, at the same time as well too, this one I was kind of debating on whether putting in as a definition here for you guys or as a term, but it's great to know as well too. And this word is basically latency. Now, latency is the time it takes for a transaction to be confirmed on a network. So let's say you just submitted a transaction, and now that you submitted that transaction, what will happen is it'll take that time. It's basically like a lag that from the time you submit your transaction to the time the first block is created to confirm your transaction on a network. And that term there is latency. Now, how this helps is you'll hear some coins or cryptos that help with the latency issue, and that's where you're going to find this term helpful. Now, we all love to say it, and especially when cryptos are having a strong upward move and they're going super parabolic, and that's basically what mooning is. Or when we say we're going to the moon, or this coin is absolute mooning. And one thing as well too, when I was making these slides earlier today, I felt like I was Urban Dictionary. Now, if you guys don't know what Urban Dictionary is, it's a website that you can go to where you can search up different slangs for different words or new words that these new generations keep coming up with. And it was just funny coming up and writing down these definitions for it. It made me feel like I've personally aged myself as well. But basically that's what mooning is. It's an expression in which a cryptocurrency is going in a strong upward move, or it's basically going parabolic and just going up. Now, at the same time, you're going to hear the term max supply. Now, max supply is generally just a number of tokens to ever be created, like how Bitcoin has a max supply of 21 million. So there's only ever going to be 21 million Bitcoins ever made, and that's the max supply, no more, no less, and that's it. And that's, again, why Bitcoin is so valued as well. Now, you're going to hear the term ledger. Now, don't compare this term ledger to what is known as the ledger nanos, because all a ledger is, it's a book or a digital file where transactions are recorded. Now, I don't know if you guys watched a lot of movies back in the 90s, or if you guys were bankers back in the 80s or 70s, where you would have, or even a bookie, where you would have a ledger to record every single financial transactions that were made. That's all a ledger is. And that's why the blockchain is important as well too. It's because it's a digital ledger. Now, at the same time as well, you're going to hear the term private keys. Now, there's a difference between private keys and public keys, but basically a private key is a long string of numbers that you and yourself own. Now a public key is something that everybody else can see. So everybody else can see that exact key, but when it comes to a private key, it's basically just a long string of numbers that you yourself alone own, and when you're sending it out, the person who's receiving will receive your private key to send that transaction out. But when it comes onto the blockchain, all you'll see is the public key. Now on top of that as well too, you've got your private sales. Now private sales, if you guys don't know, a lot of these call outs that we've been getting into as well too are private sales. Basically they're the early stages of investing, so they allow us to get into them before they release to the public. Now at the same time as well, something that that's really handy and great to look out for, especially in the DeFi space, is going to be security audits. Now all an audit is basically just a way to analyze how safe a smart contract or blockchain is against attacks. So when you see that an asset has 2 audits completed, it's basically saying that an asset has gone through the steps to confirm that it is safe, and that's gone through the steps to confirm that it is safe, and it's going to be very protected against any attacks that can happen. So that's all a security audit is. It's a great thing to look out for as well too. It just gives that extra confirmation that this asset is a good asset as well too, or even the code is a good code on the asset. Now at the same time, we've got smart contracts. Now basically a smart contract is just a contract that triggers a certain action when conditions are met. So basically, like, take a look at all these deflationary tokens. Their smart contracts is that whenever there's a buy or whenever there's a sell that happens, they get taxed, and on top of the tax, we also as the holders get rewarded for that. And so basically when someone buys, that triggers a certain action, and when that action is met, we get rewarded. When somebody sells, that triggers a certain action, and when that action is met, we get rewarded. So basically just look at it that way. On top of that as well too, Ethereum is smart contracts are basically the backbone of Ethereum, and now that Cardano's soon going to be releasing them, hopefully on the 12th like they've promised, we're going to see a whole new wave of smart contracts coming in on that platform. Now as well too, we have tokens. Now if you remember what I was saying about the coins, a crypto coin is basically built and operating on its own blockchain. Now when you have a token is a currency that is built on top of another blockchain. So again, let's take a look at these assets that we're purchasing, like FEG, SafeMoon, all these smart contracts that we've been purchasing on our wallets. Those are tokens, and the reason why is because FEG isn't built on an FEG blockchain. FEG is built on top of Binance Smart Chain blockchain. So that's where you're going to realize the difference between tokens and coins. And there's going to be tokens that are out there that will help build on top of that blockchain or help that blockchain as well. So that's why it's good to know the difference between a coin and a token. But most of all, we generally just call them cryptocurrencies. Now, you're going to hear this word, maybe not a lot, but you are going to hear it depending on who you listen to, and that's going to be the store of value. And basically a store of value is an asset or currency that can be saved, retrieved, and exchanged at a later time. Like way back when, gold was a store of value. People would put their money or their fiat into gold as a store of value that they can retrieve at any time or exchange it for whatever at any time. Nowadays, we've got people using Bitcoin as a store of value. People, I wouldn't say Ethereum is a store of value just yet, but Ethereum could be a store of value. So that's basically what a store of value is, or a way to look at it in the crypto space. Next up, this one was another one that I kind of juggled around to see if I should drop to you guys, but it is important, especially if you guys are going to go to any of these exchanges and talk with their online support or anything like that. They'll always ask for your TX ID or what is basically known as a transaction ID. So whenever you make a transaction on the blockchain, it has its own unique ID that you guys can use that will track that transaction, and that's basically what TXID is, your transaction ID. Next up, I've been saying this word the last few minutes or the last little bit, and it is wallet. Now, when you guys hear the word wallet, it's basically a place where you use to send and receive your crypto. So MetaMask wallet, Trust wallet, DeFi wallet. What else is there for wallets? There's 1inch wallet. There's a lot of different wallets that are out there. SafePal wallet that you guys can use just to hold, send, and receive your crypto. Top of that as well too, we have the term exchange. Now, exchanges are basically a business that allows customers to trade crypto. If you guys have been on any of my other classes, you'll hear me say crypto.com exchange, Binance exchange, Whitepaper, or any of those exchanges is basically a business that allows customers to trade crypto. Now, verification code. Now, a verification code is basically going to be a code sent to another device to ensure identity. Now, I know Binance does this for Binance.com. I'm not too sure if it's going to be for Binance.us as well too. But for Binance.com, when I'm trying to do a transaction or send out my crypto, they'll send me a verification code to my email and also to my Google Authenticator. And it's basically a code sent to another device to ensure identity. Top of that as well, we have paper hands, and basically paper hands are people who sell at the first sign of any trouble on any asset. These are people who do not have diamond hands, people who can hold through the rough, and again, diamonds in the rough or diamond hands, and come up profitable. Now, at the same time, we have the terminology whale. Now, whales are basically someone who owns a large amount of Bitcoin or any other cryptos. And whales, we like to say, influence the markets, or this person's a whale, or whales are moving X amount of dollars, so out of one asset into another exchange or anything like that. So when you hear the term whale, it's just basically someone who owns a large amount of Bitcoin or any other cryptos. Now, you guys are going to hear the word pump and dumps. Basically, a pump and dump, which are very risky, is where a group of people come together to bring the price of a coin up and then dump the asset to secure profits at other people's expenses as well too sometimes. So they'll come together, they'll pump up a coin's price higher, and once it reaches that absolute cap of that coin, they're gonna drop that coin and pull out a lot of their profits, and you're going to be left holding sometimes an asset that has no real value. So be careful when you hear the word pump and dumps or pump and dump groups. Now, at the same time as well too, you have the term small cap. Now, small cap gems or small cap in crypto are basically cryptos that have a market cap of under $1 billion. So that's basically, when you hear the word small cap, that's all it really is. Now, next up, you're going to hear or see videos that say this coin's going to go 10x, this coin's going to go 100x, this coin's going to go 1000x, and that generally just means that that crypto has the potential to increase by 10x, 100x, 1000x. So it's really great to kind of keep in mind what that crypto is, what it's doing, and how it can increase, because not only will it increase that amount, it'll also increase your investment. Your return on investment will be 10x, 100x, or even 1000x sometimes. Now, another term that you guys are going to see is going to be yield farming. Now, yield farming is basically, I tried to keep this as simple as I can as well for you guys as well too, but basically yield farming is you staking one coin to earn another token or coin. So basically, let's say I have my USDT. So I put it into a farm, and in turn for providing USDT liquidity, I'll get that farm's token. So a great example is the new token UF that was just being released. So UF, you stake UF, and in return you get another token, and that's yield farming. Now, you guys are going to see on top of staking and everything like that and yield farming, you guys are going to hear the words APY or PA. Basically, it's just APY is just yearly interest earned on your deposit. So you stake X amount of dollars, they pay you 6, 8, 10, 12% APY, whatever it may be. That's your yearly interest you're going to earn on your deposits. And that's another thing how crypto and DeFi is better than regular banking. But at the same time as well too, you have the word PA. Sometimes you'll see it gets 8% PA. Basically, you get 8% price action for that token, which is another great investment as well too. And then again, you're going to hear the term white paper. Now, white papers are basically documents that lay out in-depth information on a project or company. It's definitely great to read and go over if you want to know more about what the company or project is all about and what it's doing, and more in-depth information. Now, you guys might hear specific traders or different people, or even us later down the road, talk about Bitcoin dominance. Now, what Bitcoin dominance is, it's basically the market cap of Bitcoin versus all other cryptocurrencies. So how is Bitcoin performing in market cap versus all the other thousands or hundreds of cryptocurrencies that are out there? And that's where you're going to get Bitcoin dominance. Generally, when Bitcoin dominance is low, it's alt season and altcoins are going to go up. So that's what Bitcoin dominance is all about. Now, you guys may hear the word airdrop dropped here and there, or if you're on an exchange, you might see that your exchange is having some airdrops. Basically, an airdrop is an event in which you are dropped tokens or coins for holding an asset. Now, there are some things that are out there where if you're in your Trust wallet, you might get airdropped a certain coin. Don't look into those, don't touch them really, because those might be, again, phishing scams, and we'll go over that later down the road in these slides. But generally, some assets will say, hey, if you're a holder of our token, you get airdrop X amount of these new tokens that we're going to be releasing. So that's a good thing as well too. Now, you guys may hear meme coins or shit coins coming down the road. Give me 1 second. Now, when you guys hear meme coins or shit coins, basically they're cryptocurrencies that have little to no value or use case. Now, a lot of these coins may start off as meme coins or shit coins, but later down the road, they could develop to have a real use case or a real value, kind of like how Doge started. It started off as a meme coin, and now we're here. We see where Doge is at. Now, there's going to be total supply, which is basically the number of coins or tokens that currently exist. So instead of having the max supply that will ever exist, this is the number of coins or tokens that currently exist or currently in circulation. Now, at the same time as well, you're going to have token sale. So a token sale is basically the issuance of tokens in exchange for another crypto, so aka an ICO. Next up, we've kind of got the whitelist, which is a list of allowed or trusted individuals or computer programs. Now, sometimes you might have to whitelist an address. So you'll see this a lot when you're withdrawing from an exchange. They'll tell you to put in your address, and then they'll ask you to whitelist it. So they might send you to go to your email and confirm that this is an allowed individual or a trusted individual or a trusted address that you want to send your crypto out to. So that's basically what whitelist is. Now, you've got your fair launch. Now, fair launch is basically everyone can participate on equal footing of a launch of a token. And then you have stealth launch, where basically these are launched in secret to ensure privacy and to minimize the risk of bots coming in and buying and selling. And then you have the definition of doxed, which is to publicly identify or publish private information. Sometimes people don't like to be doxed, or sometimes people like to keep their identity hidden, so they won't give out that public information. But then other times there's people who dox themselves personally, and they allow people to have that public identity or know who they are. Same time, we've got staking pools, where it's basically a pool where users combine their crypto to increase chances of validating new blocks. So people will come together, pool up all their coins or tokens, and they'll put into staking, where they can earn a certain percentage of a new block that gets created every single time. So that's basically what staking pools are. On top of staking pools, you also have WETH or WETH or whatever you guys like to call it. All you need to know is that it is a tokenized version of Ethereum, just like how WBNB is a tokenized version of BNB. It's just basically a 1-to-1 ratio, and it's just the token version of Ethereum or the token version of BNB. And then on top of Ethereum as well too, you guys are going to especially if you're new to the space, you might be confused with what ERC20 is. ERC20 is generally just a standard used for any crypto built on top of the Ethereum blockchain. So when you see an asset and right beside it, it says ERC20, and you don't know what that is, just know it's the standard used for any crypto being built on top of the Ethereum blockchain. There's going to be ERC721, ERC this and that, but for right now, just keep it super basic for a lot of you guys to understand. It's just ERC20 used for tokens that are built on top of Ethereum's blockchain. Now the 20 isn't so much important, but all you need to know is that each numerical digits that come after the ERC signifies another use for it on the Ethereum blockchain. Now, you also have tokenomics. So when we talk about check out the tokenomics on this coin, or this coin's got great tokenomics, what you're going to see is that tokenomics is the function and uses of a token. So what the token's function and uses are going to be, whether it be deflationary, whether it be to reward us, whether it be anything, the function and the uses of a token, or it's going to be its tokenomics. And then you're going to hear terms like TVL or TLV, however you see it. It's basically total locked value of an asset in a DEX, DApp, or DeFi system. Hopefully I don't have to explain DEX, DApp, or DeFi as we went over it earlier, but that's what TLV means. It's a total locked value of an asset. Now on top of that as well too, you guys are going to might run into this, which is going to be liquidity pools. Now, liquidity pool is basically a form of yield farming, where users pool their crypto together to provide liquidity. It also allows users to receive passive income and hold assets while waiting for price to increase. So liquidity pools are a great form. If you guys are starting off getting into yield farming, you guys can participate in liquidity pools first, and liquidity pools will get you guys that kind of know-how and knowledge before stepping into yield farming. On top of that as well too, now this one is another one where I juggled back and forth, but apparently it's really common to know this terminology, especially in DeFi. So AMM. So when you guys hear AMM, all you need to know is that it's an automated market maker. It's basically a protocol that automatically calculates assets values based on a smart contract. So if I were to go into an exchange or a DEX and I wanted to sell X amount of a token and receive X amount of a token, the AMM or the automated market maker will automatically calculate the value of that token and give me the correct value in return of that other token. So that's what an automated market maker does. Now, on top of that as well too, you guys may run into issues with impermanent loss. Now, this will happen as there's risk in everything, but impermanent loss is basically when a price of your asset in a liquidity pool changes in price and is lower than what you originally put in. So let's say I put in $100. One day it was $150. Next day or next week or next month, it drops into that liquidity pool at less than $70 or anything like that. So that's basically what an impermanent loss is. It's a price of which your access in a liquidity pool changes. So keep that in mind as well too. It's just risk. Now when you guys run into slippage as well, now you guys might see this issue on PancakeSwap a lot, where you might have pancake K error or pancake this and that error. Basically, sometimes what it is slippage. Now, slippage is the difference in expected price and the actual price when you swap a token. So sometimes you might want to buy a token, and when you buy the token, you want to make sure that you buy 100,000 of that token. Now with Slippage, of course, you only get, let's say, 98,000 of that token instead of your 100,000, or 95,000 instead of your 100,000. So that's basically what slippage is, the difference in expected price. Now on top of that as well too, you guys are going to see the term token burn. So Ethereum just did a token burn. A lot of these deflationary assets that we purchased do token burns. Now, a token burn is basically a process where tokens are permanently burned, reducing the total supply. So what this does is that it increases supply and demand. As supply goes down, demand goes up, and hopefully price will go up as well too when they do token burns. Secretly, it's believed that Ethereum might even be just a token burn where it's going to do a lot of token burns in the future, and it's just going to increase its price. So that's there as well too. Now this one I decided to toss in because I didn't even know this gentleman's name until months into my crypto journey, and it's a great name to know, and it's Vitalik Buterin. He's basically one of the creators of Ethereum, and fun fact, he's actually from Canada, which is awesome. I believe he's from like Ontario or Quebec, in that kind of eastern region of Canada, but it's awesome, so go Canada. But at the same time, like I said, he's one of the creators of Ethereum, and the other creator of Ethereum is actually the creator of Cardano. So definitely a good keep to look an eye out on what Cardano's doing as well too. Now on top of that as well, I guess another name that I wanted to toss out to you guys, but I guess I can toss it out too, is going to be Bogdanov. And there's going to be lots of crypto memes out there that use that name. Basically, they're just these two French scientists. That's kind of like the Bill and I of the US and Canada, but they're the Bill and I of France, and they've turned them into kind of like the super villain of the crypto space. He's the one that always does the dumps on cryptos and all that kind of stuff. But definitely a good name to keep in mind as well for if you're ever looking at memes and you want to understand what this meme's all about. That's that name. But Vitalik Buterin, again, one of the creators of Ethereum. And he's only like, what, 25, 26, I believe, 27, maybe even 28, somewhere in there, which is absolutely nuts. So yeah. And then on top of that as well too, we have the definition of a large cap. So a large cap is basically a crypto with a market cap of over $10 billion. Super simple. Small cap cryptos under $1 billion, large cap cryptos over 10 billion in market cap. Now, you guys might not see a lot of this unless you're looking at actual transactions in the block explorer, but you'll see WEI somewhere in that long transaction or that long transaction history. And WEI is basically the smallest amount of ETH used for gas prices. That's basically it. It's just to calculate gas prices and the smallest amount of ETH actually used. Now there's some math to that. I didn't want to show you guys that math. Didn't find that math too helpful, but that's basically there for you guys. Now, when you guys hear tank, what you guys want to know is that a tank is an asset when an asset is losing value rapidly. So when somebody says this asset is absolutely tanking, what it basically means is that this asset is losing value rapidly. It's absolutely just dropping. You guys might hear in the the Forex side where somebody says this asset's absolutely tanked and you guys are in a sell, which is a good thing because you're making money on the way down. But in crypto, when an asset's tanking, you generally just want to take your assets out of there to kind of prevent that loss. And then at the same time as well too, you're going to hear the word trustless. Now, trustless just generally means no single entity or governing body has authority over the system, and a consensus is achieved between parties who do not have to trust each other. And consensus and trustless is what Bitcoin basically is all about. Having that consensus and trustless, consensus and trustless peer-to-peer system in which Bitcoin runs off of, meaning I don't have to tell you that I paid you. Let's say two people, one person asks another person for $20, and now that one person doesn't have to go back and say, hey, I've already paid you your $20. They don't need to trust each other because everything is going to be on the ledger, the open ledger in Bitcoin. It will show that person A has paid person B $20 and person B has paid back person A $20. So when it says trustless, consensus, all of that, it's going to be basically showing why Bitcoin is so important, and I'll go over that in my blockchain video for you guys as well too. Now with TPS, you guys, all you need to understand is it's transactions per second. Now this is just means how many transactions per second can occur in blockchain do. So some blockchains can do 10,000 transactions per second, and some can do 100,000 or 30,000 transactions per second. So it's definitely great to know that term, especially if you're looking at fast transactions or fast protocols that are out there. TPS is a good term to learn. And when you hear the term pegged currency, so pegged currency is basically a currency where the price is made to remain the same as a currency it's tied to. So like how we'll say stable coins or USDT are pegged to the US dollar, meaning that they have the same value as the US dollar. So you don't have to worry too much about the volatility going on with those tokens. Now, these next two slides coming up are really great, because you'll hear of different Oracle protocols or even protocols that are out there. But basically an oracle is a data source from a third party used to determine outcomes for smart contracts. So if you're reading through, let's say CoinMarketCap, you want to know what a coin is, and it says Oracle on it. Now you know what an oracle is. It's just a data source from a third party used to determine outcomes for smart contracts. Now on the other hand, you have protocols, which are basically a basic set of rules that allow data to be shared between computers. Now guys, I know this class is a little longer here today, but we're almost finished. We've got a few more slides to go, so stay with me now. But basically a protocol is a basic set of rules that allow data to be shared between computers. Now on the same side as well too, there's going to be a few different wallets that are out there. Now the most common definitions for them are going to be hot and cold wallets, or offline wallets and online wallets. But there's a few other definitions that are going to be out there. Now there's going to be paper wallets, where basically it's just a crypto address and their private keys where they're physically printed out on a piece of paper. So they're paper wallets. So those ones are going to be cold wallets, where they're offline. They're not connected to the internet at all. Then you're going to get software wallets, which are basically applications that sit on your hard drive and allow you to complete control over your assets. Now there's very few of these software wallets that already exist and are out there. Now a lot of you guys might not know of them, which is completely fine, but for you, more of you experts that are out there, you might have some software wallets that are sitting on top of your hard drive. Now then next you guys are going to get hardware wallets. Now hardware wallets, like the Ledger Nano X here, or even like the Trezor, or even like what other wallets are out there. There's a bunch of hardware wallets that are out there, where basically they're wallets that function offline and are not connected to the internet at all. They're a piece of hardware device where you send your crypto to, and you have to physically connect it to the internet to be able to use them. So those are basically hardware wallets. People use them to be extra safe or extra careful with their assets, especially when you have a lot of a certain currency that you don't want to lose. You always want to make sure you get a hardware wallet or an offline wallet to put it on. And I'll make a video for that for you guys later down the road as well too. Now, on top of that as well too, here there's liquidity. Basically liquidity just means the ability to sell or buy an asset without causing massive fluctuations in the market. So let's say you were to buy an asset off PancakeSwap and you want to sell that asset, you guys will see that at the bottom there it shows the impact, the price impact for you selling your assets. Now when a cryptocurrency like that gets listed on an exchange, and I'll go from listing next, is basically you'll notice that they have instant liquidity where you can sell your asset right away without causing any massive fluctuations in the market. Now that's why liquidity is important. Now at the same time as well too, you have listings, which I just talked about, and it's basically when when a crypto is getting added to an exchange, or when you're adding an asset to an exchange. And that's basically what listing means. Now there's going to be Lightning Network as well too. Now it's kind of raining here, which is kind of funny, but there's going to be Lightning Network. Now Lightning Network is, again, a second layer operating on a blockchain that enables increased transaction speeds. So it helps with that scalability of that blockchain in terms of increased transaction speeds, or TPS. So that's what, if you're looking through an asset and it says Lightning Network for X blockchain, or Lightning Network for X crypto, that's what it is. It's a second layer operating on a blockchain that enables increased transaction speeds. Now, this is one that you guys definitely need to know, and that's going to be seed phrase. Now, generally, a seed phrase is just a 12 to 24 confidential words that can be used to access your wallet. Now, when you guys are opening things like your MetaMask, your Trust wallet, if you guys were to get your Ledger or your Trezor, any kind of wallet device in that sense, while you're making it, they're going to tell you to write down 12 to 24 confidential words and to keep it in a safe space. Now, that's your seed phrase, and that's essentially access to your wallet. Without your seed phrase, you don't have access to your wallet. So definitely make sure to write it down on a piece of paper, write it down 2-3 times, keep it in confidential places as well too. Now, I know I've mentioned this in small cap and large cap, but what is market cap? And market cap is basically just the total trading volume of a crypto. So when you guys hear that this asset has a market cap of X amount, and it has the potential to have a market cap of X amount, what it just means is the total trading value of a crypto. Now, mining. Now, we all hear the term mining cryptos out there. We'll have those bots messaging us about, oh, mining crypto and everything like that. Mining crypto just essentially means the process of verifying transactions on a blockchain. That's all they're doing. People buy these expensive machines to run and operate, essentially just to verify transactions on the blockchain, which helps us because now our transactions are being validated on a blockchain. Now, on the other side of mining, you'll have a node, which is basically a user on a blockchain that communicates with other users. So all these nodes on the blockchain will have to reach a consensus before a new block is added on the chain. And I'll go over that on my blockchain video for you guys who are experts in the field. You already know and understand what nodes and how nodes kind of play out in that sense. But basically, a node is just a user on a blockchain that communicates with a bunch of other users. Now, on top of that as well too, I spoke about this earlier, which is phishing, or however it's pronounced. Now, it's basically the attempt to steal information to gain access to an account. Now, this has been a huge thing way back with emails in the early 2000s. Where they're going to send you an email, you click and open the link, and from there they just kind of steal information off your computer. Now, it's not as apparent in crypto, but it's definitely a good thing to keep out for. Personally, I haven't experienced too many of these, but it's definitely a good thing to keep out for. Make sure that all the emails that you're receiving are exactly from where they say it is. Crypto.com, I love, because they do this thing where you can come up with a random code. You can type in random numbers and letters, and it's your anti-phishing code. So whenever you get an email from crypto.com, it will show your anti-phishing number, so you know that it's a legit email from crypto.com. So check out if any of your exchanges that you guys have that anti-phishing, so you guys can set up your own codes, so that way if any emails come in, you guys know it's exactly from the exchange you set it up with, and that it's a safe email because it's going to be your code that you made. Now, on top of that as well too, talking a little bit about Ponzi schemes. Now, I didn't even learn this terminology till earlier this year, which is absolutely baffling. 25 years on this world, and I haven't even heard of what a Ponzi scheme was. But it's essentially just a scam where new investor funds are used to pay previous investors. So You don't see it a lot in cryptocurrencies, but again, you might see those Ponzi schemes arise in crypto, especially in times where there's ridiculous volatility and the greed in the market is there. You might see those things pop up here and there, but be careful. As long as you guys follow the proper steps, follow your proper investing plan, you guys should be safe. Now, there are going to be obviously the one or two, but don't worry about that so much. Yeah, as long as you guys dollar cost average as well too, you'll be safe. Now, at the same time as well, you guys might hear the terminology wrecked. So I know when you play video games, if any of you guys are out there, you might hear somebody say get wrecked, or I don't know if that's even still a thing, but basically when somebody says, oh man, you were wrecked, it's basically slang for someone or something that has been destroyed or experienced catastrophic failure. So when something gets wrecked, they've experienced some catastrophic failure or have just been decimated or destroyed. So that's where you're going to hear the term wrecked. Now, when you hear roadmap, and you guys are going to see this a lot, where follow the roadmap or check out the tokens roadmap, it just basically, it's a layout of short and long-term plans of a project. It's what that project plans to do in the short term and long term, and they've laid it out for you in a roadmap essentially of what they want to accomplish. Now, I've said this prior when it comes to pegged, but a stable coin is generally just a coin that is pegged to fiat. So what I mean is that a stable coin that's pegged to fiat, let's say USDT or USDC, it's pegged to the US dollar. So if you guys want to take out profits, but you guys don't want to put it into your bank account just yet, but you guys don't want to keep it in the asset because of the volatility, you can move it to a stable coin like USDT or USDC, where it's valued at the US dollar, and you won't have to worry about any of that major volatility in the market. Now, on top of that as well too, one thing that crypto or blockchains that are out there that help with is the double spending. Now, double spending, I believe, was a huge thing in the early 2000s, or even in the banking world. Essentially, it's basically when a given amount of coins are spent more than once. So that's what the blockchain was kind of there to help out with as well too, is double spending when it comes to real life banking, where let's say I give you $1 and I spend that same dollar again. So that's where it kind of helps in that sense with double spending, since everything is already recorded on the blockchain and it's on that ledger already. Now, next up, we've kind of got gas. So you might hear this when you hear Ethereum's gas is way too high, or you have to pay this amount of gas to mint this NFT, or when you see the gas transaction, or you need to increase your gas. So you'll hear the word gas, and it basically just means the cost of operating smart contracts and transaction fees. So that's all gas is. It's just the price of operating a smart contract and the transaction fee for that blockchain. Now, on top of that as well too, you guys will see gas limit. Now, gas limit is just the maximum a user is willing to pay for a fee. So let's say you want to set an NFT, or you want to mint an NFT, but the gas prices are so high, you can set your gas limit, send your transaction through, and if the gas hits your gas limit or goes under, your transaction will go through. And that's just another thing to know as well too. And then you're going to have GUI or GUI, or however you sound it out. Wow. Basically, it's the measure of gas prices. So that's how they measure gas prices on the Ethereum network, is with GUI. And then next up, we have the Genesis block. And a Genesis block is literally just the first block recorded on a blockchain, or the first block of a transaction. Now, I'll go more in depth with this in my blockchain video for you guys, but just know that Genesis block is the first block recorded on a blockchain. Now, on top of that as well too, you guys might heard of halving, or the Bitcoin halving. Now, this is generally when the mining rewards are cut in half of what it was before. So it happens every 4 years for Bitcoin, kind of like the Olympics. It happens every 4 years where miners, their rate that they get rewarded for mining gets cut in half, and they do that every 4 years. So that's why the Bitcoin halving is such a significant event in crypto. Now at the same time as well too, lastly, we've got hash rate. Now this is more for those minings. Basically it's the speed at which a computer or mining hardware is able to calculate new hashes. Now guys, I just wanted to say thank you so much for coming to today's class, and I appreciate every single one of you guys. Now that's all I have for you guys here today. If there's any definitions that I've missed or that you guys want me to go over at a later time, definitely hit up any of my social medias. They're all present right there, whether it be my Facebook, my Instagram, or even my YouTube, and just drop them in the comments or even hit me up in the DMs, and I will definitely go over those definitions for you. If you guys have any ideas of what you guys want a video made on, definitely let me know, and I'll make a video there for you guys.